Welcome to another episode of Test, Optimize, and Scale. Honored to have Jeffrey Marks here with us today, corporate and securities attorney, entrepreneur, and equity crowdfunding expert. Jeffrey, thanks for joining us.
Thanks for having me.
And we first met at a Start Engine conference years back. I've seen Jeffrey Marks' name attached to many of the most successful campaigns industry-wide. So very interested to learn more about the legal side of how these campaigns are structured and just overall outlook towards what makes a successful round and what does not on these types of campaigns. But Jeff, wanted to start with your background.
I got out. I went to Loyola Law School and got out in 1995, and went to work at a big law firm, Paul Hastings. Back then, it was Paul Hastings, Janowski and Walker, and practiced corporate and securities laws and M&A. Back in the day, was working on a lot of the big. It was during the internet boom. Was working on a lot of the big internet IPOs and the tech IPOs, and then got hired to become general counsel for one of my clients, which was a public Nasdaq company, and that had IPO'd. They went out of business about 18 months later, and I went out on my own and hung up my own shingle in 2001, and have been practicing law ever since. I was introduced to crowdfunding about 6 months before it went live. I met the owner of Start Engine, the CEO of Start Engine, and one of the directors, Howard Marks, through Young Presidents Organization, which is a group I'm involved in. And he basically was the first I heard of crowdfunding, and he said, "Jeff, you got to get into this. This is going to be huge." And so through Howard, I got into it and started helping companies structure and do their Regulation CF offerings, and then moved into Reg A pluses. And these days my practice is more limited to Reg A pluses and helping companies prepare for a crowdfunding offering or for a Reg CF, rather than actually doing the legal work associated with the Regulation CF, because these days the issuers are doing most of the onboarding on their own. But companies that need to restructure, maybe they're a limited liability company and they need to restructure into a corporation. I do a lot of that work now. Still do lots of work with Start Engine. I think they're one of the best in the business. And one thing that I always tell my clients, and which they appreciate, is I'm not just a corporate lawyer that's been sitting behind a desk in an ivory tower for 25 years. I'm an entrepreneur. I started a successful restaurant business in Las Vegas in 2005, and we've got two restaurants at the Mandalay Bay and one off the Strip they're doing well despite the pandemic. And I was part of a early stage online direct-to-consumer marketing company that was started in 2017, and we sold that to a public company right before the pandemic hit. And right now I'm involved in a brand new startup, not brand new, it's about 8 months old, but we're in the auditing space, health and sanitation auditing of multi-unit locations, and we just started generating revenue a couple of months ago.
Wow.
Yeah.
So quite a journey there, starting with the M&As, learning about equity crowdfunding, connecting with Howard, both last name Marks. I'm guessing no relation since you guys met at that event there. I was always curious, and the and then your whole world of entrepreneurship outside of that, from the direct to consumer marketing company. Have some questions on that, and then the health and sanitation auditing. Definitely see a need for this space here in 2021 for that, as well as your focus on Reg A plus campaigns and LLC to corporation type of structuring and work around that. Just starting with the direct to consumer, that's an amazing exit, 17 to 20. Was that digital? Were you guys doing a lot of advertising or different channels that equity crowdfunding campaigns use?
So no, well, the company started with 4 people that were very, very exceptional veterans in the digital marketing business, and they originally were selling their own products online. And a team of us, me and a couple other people, came in and saw the opportunity to create a SaaS platform. So we did a couple of acquisitions. We raised about $23 million. We grew the company to, at its height, it was on a $65 million run rate. We were doing about $7 million a month, and did the acquisitions, and then sold it off, and sold off we had a content syndication business, which we sold off to a competitor, and then we sold the marketing side to a public company. So
Very impressive.
it was more products. It was products, basically.
Mm-hmm. Finding something that's popular in searches on an e-commerce platform, and being able to drive traffic to a funnel to convert them, scale things up. Very interesting about the content syndication and everything involved there. Yeah. I rarely hear about experts on the legal side with that type of understanding of marketing as well.
Well, thank you.
And I imagine you hear vice versa. And that really says a lot, for any founders listening in, to know that you've gone through this, you've done a substantial raise, you guys were putting heavy revenue on the board and have actually done a successful exit. So it's more than just, hey, here's how you structure something, to no, this is the actual path, and I've gone down it myself.
Yeah, exactly. And it's that, and also, being an ex-big firm lawyer, and working with a lot of companies, and big firms are great and serve their purpose, but for smaller and earlier stage companies, and my approach is not to tell clients, all the reasons why they can't do something, but to help them figure out how they can do it. And to look at the risks, and explain what the risks are, but of doing certain things or taking certain actions, but not beating it down their throat. If they know the risks and they're aware of them, then let's proceed. So
absolutely. And speaking to the intention, the ultimate goal, versus getting caught up on one aspect of it.
Exactly. It's not, look, there's 20 issues. These 3 are the ones that are really, really have a likelihood of coming back and biting you. So let's focus on those, and we'll sacrifice in the other things in order to get the most important things.
Absolutely.
Yeah.
Speaking to the ultimate goals, we have to do that a lot on the marketing side. And likewise, we're not there to shut down groups and say that's never going to work. More of how to get it to work, and working on their behalf towards the larger picture. So definitely refreshing to hear. And at what stage are you usually speaking to groups who are planning an equity crowdfunding campaign? Are they generally engaged with the portal already? Are they far out and working on a business plan to one day launch on one of these platforms?
Most of the companies I work with come from Start Engine, and they're signed up and ramping up, they're usually a month or 2 or 3 away from launching for Reg CF, for Regulation CF.
For Reg CF, okay. But you said mainly Reg A plus these days, but for Reg CF, that was the typical process, 1, 2, 3 months out.
Yeah,
Okay.
And I'm seeing a lot. I did 7 or 8 Reg A pluses last year. Mm-hmm. I'm seeing a lot less of those, and which is natural, because the limits for Reg CF have been raised to $5 million, and most of the companies that I deal with are looking for less than $5 million. So
plan on doing more of those with the expanded rulings.
Yeah.
Excellent. And our listeners, they hear about this regularly, but Reg CF allows for accredited investors up to 1.07 million. Pre-March 18th, now 5 million. Reg A Plus went from 50 to 75 million, again, both from accredited and unaccredited. But the filing's much more in depth for Reg A Plus, I'm told. It's almost similar to an IPO process, or a percentage of the way there. There's a lot more analysis involved.
Oh, yeah, it's kind of like a mini IPO. The disclosure is not as heavy. You know, with a Reg CF, most companies don't even use a lawyer. You know, with a Reg A Plus, you know, you're going to pay, you know, 50 to a few $100,000 in legal fees, depending on who you use to do it. So
yes, and what are the timelines associated with that?
You know, it depends on how complex the company is. If it's a pretty, you know, how complex they are, you know, how many financing rounds they've done in the past, how complex their cap table is. But usually, you know, we can put together a draft document within a couple of weeks of getting all the information. And then it's a matter of going kind of back and forth and finalizing them and finalizing it. And once filed, you know, the SEC has 28 days to turn around their first round of comments. And once they do, you respond to the comments as quickly as possible. And they've got 5 days to turn around the second round of comments. The fastest I've ever gotten one through, I've got 2 through in 35 days.
Wow.
But, you know, usually it's 45 to 60 days to get it through and get it qualified by the SEC. Usually the holdup is, and I love my CPAs, but usually the holdup is getting getting the audited financials completed, because you know, there's a lot involved, and oftentimes the information is not readily available, and so oftentimes that delays the process. So anybody that's considering doing a Reg A Plus, that's the first thing they should get moving, is on their audited financial statements.
Sure, I've definitely heard that slow things down, and historically have seen longer waits than that. Not associated with your issuers, of course, but Reg A Plus, I almost anticipate a delay, more of 4-6 months, when there's a 2 to 3 month projection, and so on and so forth, when we're putting our own internal timelines together in-house.
Yeah, I mean, I usually will get them through in, you know, 2 to 3 comment letters.
Okay.
The longest one I did was a company, and it was several, and we ended up just withdrawing because it was they were doing a crypto, and it was before the SEC had approved their first crypto Reg A Plus, and so it was just comment after comment after comment, and part of me thinks it was just kind of delaying, you know, approving like a crypto Reg A Plus, and finally we just threw our hands up and just terminated it. But
Sure.
years ago.
I was going to say, I saw a lot of groups with a similar story in about 2018, and tokenized Reg A Pluses felt like they were right around the corner at that point. I know there has been a few that have gone through. Is it more of a regular activity these days?
You know what? I haven't followed much. I haven't
Yeah.
followed. I've done less crypto related stuff.
Sure. We still work with broker dealers, apps, exchanges, things along those lines. Trading's obviously been up this year, but definitely crowd sales were a few years back for us in any capacity there. Have also seen campaigns raised on these portals. I know Republic does more on the crypto side. We've even had some very successful campaigns in the Start Engine front over there. What about Reg D campaigns? Do you ever recommend that route, or a side-by-side with the Reg CF, allowing for a accredited investor to participate with different terms, however, with a higher minimum?
Yeah, many clients do that. That was especially useful when the limit was 107, was $1 million, because you got a big investor that wants to come in. You could take them on the side, just, you know, through subscription documents, and not fill up, you know, the Reg CF. So you could, you know, basically raise more money that way. But I still see a lot of clients do that. Most of them do it on the same terms. And there's 2 types of Reg Ds. There's only one difference. One is the 506C, where you generally solicit. You can advertise that like you can a Reg CF or a Reg A Plus. And the other is where you don't use what they call general solicitation. Now, there's a one difference, but it's a very important difference between the two. When you do a 506c where you're advertising it, the key difference, really the only difference is that you've got to independently verify accredited investor status, which means that the investors either got to submit their tax returns, and which have to be reviewed to the company, a financial statements, or a letter for their attorney and accountant. And what I've seen is that often just dissuades people from even bothering, right? If they have to go through those steps, just on to the next one. But I do have clients that have successfully that have done well at the 506c. Another route is to launch your crowdfunding offering, your Reg A plus, your Reg CF, and you'll often get. I have a lot of clients that often get people calling and say, "Hey, I'm an accredited investor. I want to raise a larger amount. Can you do a separate offering at a lower price?" And you can do that as long as you're disclosing in your Reg CF that you might, and you're going out simultaneously under Reg D, and you might raise money at with securities with better terms or even a lower offering price. So,
yeah, we're brought on to 506Cs, and they're definitely hit or miss. I like your comment there on, with the Reg CF, Reg A plus, you could still get those calls. And because they're going to have to go through that KYC, know your client process, anyway, with the 506C, it could be just as beneficial, it can be just as straightforward. So focusing on the other campaign and seeing what emerges from there.
Yeah, and what I always do is it actually is pretty simple. If I've got a client with a Reg CF and they call me and say, I've got an accredited investor that wants to come in, generally you use a private placement memorandum, and there's not legal advice, but what I do is I have just a generic subscription agreement, and in the subscription agreement I put a link to the to the Reg CF, and so basically says I reviewed and understand the current regulation CF and looked at all the risk factors, and you put that in there, and that's kind of a cover your ass. So you don't have to put together this full-blown private placement memorandum. You don't have to spend the money to do that. It's kind of like an easy disclosure out there, and you don't have to give any disclosure when you do a Reg D, by the way. You are not required under the rules, as long as they're accredited, that you're not required to give. As long as every single person in the offering is accredited, you are not required to give any disclosure. But it's always a good idea to have risk factors, and if you have a Reg CF to, link that in, so you're covering yourself.
And that's because accredited investors generally have more familiarity with these type of deals versus an unaccredited audience.
Yeah, the SEC says accredited investors can take care of themselves, and you need a bunch of securities disclaimers and stuff that are required. But as far as like disclosure of company information, theoretically under Reg D, not 506C, but under the regular traditional Reg D, you just need them to sign a subscription agreement and attest that they're accredited. So.
Absolutely. And again, we've seen it to be more hit or miss from the marketing perspective. Even marketing campaigns that have produced very little to no results on a Reg D, but the return can be higher based on the average investment amount on a Reg D, where a Reg CF, if you follow the portal's recommendations with their whole formula and first degree connections, really participate early on in the round. The portal's audience responds from their digital marketing, adding more traffic, then we've seen more consistency. Maybe not the same return or overarching raise amount, but it's just more of a tangible process. A lot more variables on the Reg D and larger amounts, as well as the offline conversations that typically occur there from our experience.
Yep.
And what are some general pushbacks that you receive when submitting this, or what are some of the key areas that founders find the most difficult about the filing process? Is it based around valuation? You had mentioned past financial raises. Is there anything that is commonly an issue when submitting or a larger discussion point?
They just need to make sure that they disclose everything. Disclose everything. Go through and really think of every single related party transaction, all your possible risk factors. A lot of the portals have these generic risk factors that cover everybody. But when I do these, that's like 1/3 of the risk factors. So, for example, if it's a restaurant or a liquor company, there's a whole set of risk factors, that should be included just to protect the company. They want to make sure that they, disclose what I had mentioned previously, that they might go out and do other offerings simultaneously at lower prices. And just make sure they've got all their corporate documents in order. I mean, now there's a lot of things a lot of issues I see with companies that come up that either with their structure or with their structure of their crowdfunding that I would point out that I think are important things for companies to keep in mind. If you'd like me to talk about some of those, I'd be happy to do that.
Sure.
One thing that companies don't think about is having a large number of people on their cap table. If the company is a company that has aspirations to get institutional financing one day, they might want to consider having a buyout right, some kind of reasonable buyout right, and the offering, so they can get rid of the holders if they want. They can buy them out at some reasonable price. Now that might be a deterrent to some investors, so you got to weigh whether that's going to deter investors. But if it's a generous enough buyout, just something to consider. There is, I see a lot of companies, a lot of platforms have extra perks when they, for investors that invest a certain amount of capital. For example, they might have a perk that says any investors that invest $1,000 or more get 50% off of all products purchased. Right now, there's major issues here when and I see this all the time. 50% of all products purchased forever. What if we're not purchasing products on your website and you go commercial and you go on Amazon, and then you're going to purchase products and then come back to me and ask for the refund? What if important is not for commercial use? So now I can go and purchase all your products at 50%, and then I can open up an Amazon store and sell them and make a 25% margin and undercut you. And so there's all kinds of where people put perks in where they got to be careful. Not for commercial, for personal use only, or it lasts up to you can purchase product up to $500 every year, stuff like that. A lot of companies have we'll take you to a basketball game with management, right? Or we'll take you. You can have dinner with management. Well, are you paying for their airfare? Are you paying for their hotel? Is it first class? Is it not first class? So all those kind of things you really need to think of before you just throw out perks. A lot of companies, and I see half and half. Do I go out with common stock and first of all, you don't want your crowdfunding investors to have voting rights in general. So you do go out with regular common stock and then add a voting proxy into the subscription agreement, which states that the CEO has all your voting rights? Or do you go out you create two classes of stock, a Class A stock, voting stock, and a Class B non-voting stock, and issue the Class B non-voting stock to the investors? And then, there's clearly they don't have voting rights. Some companies, for different reasons, do the voting proxy with one class of stock, and some companies do two classes of stock. When you do two classes of stock, you now have a more complex cap table. And so what I would recommend to anybody that does two classes of stock, that the articles of incorporation for the company contain a provision that says that the board of directors at any time may convert the Class B non-voting stock into Class A voting common stock at any time. And because if the company ever gets listed, they now have two classes of stock, and there's a very complex process that you have to go through, even though it's to their benefit. You know, to convert into voting stock. There's the securities rules provide significant disclosure. It would be a very large undertaking to do that unless you put that into your articles of incorporation. So, you know, there's some little things, you know, like that companies should watch out for. When companies are structuring, I don't see it often, but the biggest thing I see is early stage companies should never give out anti-dilution rights, where they say, you are my first investor, we're giving you 10% of the company and you get to keep 10% of the company forever, no matter what. And it's called full ratchet anti-dilution protection. Full ratchet anti-dilution protection is really a death knell for any company that wants to raise a significant amount of capital in the future. So that's kind of the biggest one that I see. You know, non-dilutable shares. So I'd stay away from non-dilutable shares. I mean, those are the major ones. For companies, stockholder agreements are important for companies that have a lot of share. You know, there's more than one founder. And a stockholder agreement wouldn't be entered into with the crowdfunding shareholders, but with, you know, with the founders. And what that says provides is that there's rights of first refusal. If one of the founders wants to leave the business and somebody offers to buy it, he's got to give the first right to the other partners to buy his share. And even more importantly are voting rights, director appointment rights. So if founders want to make sure that they have the right to sit on the board, if somebody has 30%, there's three founders and it's 30, 30, 30, without a voting agreement that guarantees that each three of those people can appoint a director, two of those shareholders can basically gang up on one and just boot somebody out, and he's off the board and he just is a shareholder of the company. So stockholder agreements are important for companies that have more than one founder. So.
Absolutely. I hear so many groups that we work with, or I should say more prospective clients, talk about these items. Learned early on about the dangers of anti-dilution type of scenarios. Really interesting to hear you talk about the perks, because we hear them thrown around quite a bit. And us as a marketing agency really try to distinguish that we as well cannot give anything that even remotely looks like legal advice. Everything goes to compliance. Hey, have you sent this to your legal team? Do we know it's compliant? If we're pulling messaging from the offering page and all of that has been signed off, we're in a safer place. And, you know, emphasize that we're merely an agency working on their behalf, and this should all be, you know, again, going through the right channels for approval. But I hear perks added on the fly at times, and definitely try to look at it in the same light as you're mentioning of, well, what if all these other factors are occurring? Is there some larger clause that says you're able to decline any of these for any reason, or, you know, what does it look like? But the perks definitely feel like they could be operating outside of all of the hard work that has been put in towards the filing. So really glad you mentioned that. I actually hadn't thought about it from all of those details before.
Yeah, and I see it all the time, all the time. In fact, most of the time that I see, you know, these kind of perks where they're giving discounts on product or flying, so you know, so you can come out and meet us. Most of the time, I do not see disclaimers, which really could get a company into serious trouble down the road. You know, they legally agreed to give me product at 50%. Great, I can buy hundreds of thousands of dollars of product every year, and, you know, go sell your product and take your business. So,
with my $1,000 investment.
That's right.
And the buyout right and everything there, that definitely goes in depth on different obstacles you see common there. And it's great you're able to work through groups and you know, take it to a point of success. What type of recommendations do you generally have for startups or any stage company that's looking to go down this route in terms of how they should structure anything that they may want to test out? What are some regular types of narrative that you provide?
Well, generally I say, first of all, these are generalities, but I would never do any kind of preferred stock. You can sell common stock in a crowdfunding offering. Another thing is if sometimes founders or certain early investors before they go into crowdfunding will have some kind of preferred stock, which makes the offering less attractive because there's people that get paid in front of the new investors. And so one thing is I would encourage companies to go to their early stage investors and see if they can get them to, convert preferred to common stock, right? It'll just make it easier to raise money, whether it's through crowdfunding or otherwise. And there might be a need to, bump up their percentage a bit in order to get them to convert, right? You own 5% of the company in preferred stock. We'll convert it to common and we'll give you 6%, whatever it is. But encourage companies to get rid of preferred stock. Crowdfunding is really about marketing. So, it's all about marketing. So, best case scenario, you've got a huge database of companies like my friend Storm Saunders. I did his Reg CFs and his Reg A pluses, and Saunders Bikes had an incredible following. And when he launched his crowdfunding campaign, an email went out to his database, and this thing just filled up like you wouldn't believe. So companies with large databases, leverage your databases and get the right marketing firm. You're the marketing expert, Jason, but I think you're doing it's mostly really social media marketing is I think kind of
Key driver.
Most effective. And so you got to get a good marketing firm. So a common misperception is, I'm going to stick my offering up on a portal and they will come. It just doesn't work that way. When you're dealing with a company like Start Engine that's got a lot of organic traffic, you will get investors through that if you've got a good offering, but you got to market. You got to hire Jason Fishman to market your offering, because that's what's going to make it successful. So
I appreciate that name drop there. And yes, I definitely believe marketing is a key component of this. It all starts with you structuring the deal accordingly for success, using that roadmap that you had just mentioned. Definitely agree with the audience data. And as you mentioned for Saunders, if we were to put together an equity crowdfunding calculator and project how much a brand could raise, one of the key questions would be, how large is your existing audience? What percentage of them may want to become user owners? How large are your investor, prospect audiences? That's one of the largest value propositions that we bring to the table, is our audience data and being able to drive historical equity crowdfunding investors across various portals to an offering. And that is something we can do every time. The performance, still a massive variable. We never, guarantee that in terms of the reception of what the offering could be. We see the chances of success go up with frequency alongside that. And as you mentioned with the Start Engine audience or any portal's audience, as your campaign carries momentum, they get more and more interested. The Start Engine investor, founder audience that's backed their own campaign, they're highly active. And if they see a lift and Start Engine's featuring with emails as you're hitting different milestones, as they promote each issuer the same, the visibility is just going to lead to more backing, but need to be able to do that in scale to hit these larger milestones. So ongoing marketing effort.
Yeah.
And yes.
I was going to say what I found is, as a securities lawyer for 25 years and an entrepreneur and raising money, I've raised a lot of money from my own businesses and my restaurants, and life is really about telling a story.
Yes.
And that's why we hire marketing agencies. It's about weaving a story that's going to have an emotional appeal to investors. That's really what it's about. And if yes, you need a great team and you need a product, but it's about the story.
Yes.
And so it's about a compelling story and filling a need that doesn't
Absolutely.
exist. Yeah.
Especially for private equity, early stage, When you ask the investors why they acted, the story is referenced. They had that emotional connection. They see the trajectory, but they want the experience. They want to be involved in where that organization's going and, you know, have a return. Definitely for larger types of private equity, the due diligence is more intense, but we'll see minimum level investors, $100, $500 investors, so compelled by that storyline that they hop in. But I do need to ask, what do you recommend when a campaign's not working? We've been brought to the table at times when an issuer's raise has plateaued. In other cases, clients have seen strong results with us and then kind of slowed down a bit. So, you know, being able to problem solve in that scenario, we have seen things turn around and even hit the hard cap. But what do you generally communicate if an issuer did everything from the legal side and now their campaign's slowing down?
Well, you got to go back and take a look at your story,
Yeah.
and you know, perhaps your valuation is too high. Now, it's absolutely true that when you crowdfund, you can command a higher valuation than you can when you're going to, you know, institutions and more sophisticated investors. But I've seen companies launch, you know, raises with ludicrous valuations, and you know, it's not my job to as an entrepreneur, I'll say something. You know, I can't give advice on valuation, but as an entrepreneur, I'll say, look, as like an entrepreneur, you know, I'm telling you that your valuation is not high, is too high. So yeah, look at to answer your question, look at the valuation, look at your story, maybe go back, get some more traction and try again. One more really important piece of advice that I'd like to provide. A lot of companies are limited liability companies, or corporations, and which is different from a C corporation. With a C corporation, there's two levels of taxes, and the losses don't float up to the investors. So the founders of a S corp or limited liability company get to claim personally the losses of the company because they float up to their individual tax returns. There's a lot of benefits to that. And when you crowdfund, it's generally not a great idea to be a limited liability company, because with limited liability companies, you've got to send a K-1 tax report to every single one of your members. You have 3,000 members. It becomes a laborious task. And also, you know, people understand corporations more than limited liability companies. Limited liability companies are great for certain tax benefits for real estate deals, or for businesses with not a lot of investors, but you know, the corporation is the better fit. And with the S corporation, you default out into a C corp status, which is less favorable tax treatment when you hit 100 shareholders. So what I'm getting at is that oftentimes LLCs or S corps convert to a C corporation in order to you know, start a crowdfunding raise. And what I suggest to my clients that do not convert to a C corp. If you're an S corp, and if you're a limited liability company, convert into a corporation, and you have to file S corp election status within, I don't know, 140 days or something. And that way, if you engage in a crowdfunding raise and it's not going well and it's not successful, and say you only raised $50,000 and you decide not to close it, you're still an S corporation. Whereas if you close it and you have more than 100 shareholders, you'll automatically default to a C corporation. And the reason that I'm saying this is because it's very easy to, you can, any day you can take an S corporation and just convert it to a C corp, very easy. But to take a C corporation and convert it back to an S corporation is very difficult. So what I'm suggesting is any company that's an S corp or any limited liability that's converting to a corp, maintain or elect your S corp status. And you have that in case the crowdfunding round is not going as successfully as you'd like, and you decide you don't want to close it. And then if the crowdfunding round is going well, you close it, you automatically default to a C corporation, you have your accountant file the election anyway, and then you're good to go.
Interesting. I had not heard that before. I knew about going up and down, but to maintain the S through the process and then move up to C, when the time is right, and the difficulties going back down, and if the campaign's successful or not. So it's a great thing to talk about when speaking to whether a campaign would work or not work. So, Jeffrey, everything you've shared here has been very insightful. Is there any closing notes that you want to add to wrap up the chat here? Any message to founders, marketers, or industry professionals?
All I have to say is when I first heard of crowdfunding, I thought, oh my God, this is going to be a nightmare. A company having 2,000 shareholders, because anybody who's raised money for a company knows that the smallest share, you're raising in $50,000 increments or $100,000 increments. You let somebody in at like 25, he's always the biggest pain, right? The smallest investor is always the biggest pain. So my God, why would you want to raise money and bring in 2,000 small investors? But I turned out to be proven wrong. I've seen very, very few instances where the crowdfunding shareholders are bothering the company. And so that just turned out not to be the case, I guess, because they're just, most people are buying $100 to $500 worth. It's just not worth their energy. But crowdfunding is just, it's democratized the fundraising process, made it easier for small stage companies that don't have access to capital and accredited investors. And it's given an avenue for non-accredited investors to invest their money in companies. And so I love the whole crowdfunding model. It's getting more and more acceptance and less stigma. I'm not sure that there's much stigma associated with it anymore. And I just think it's it's a powerful tool that has given people a way to raise money that ordinarily wouldn't have access to that money. So, and the best companies to crowdfund are companies that have loyal followers and have, something that, again, it goes back to the story. So
Wholeheartedly agree. That word powerful is how we describe it as well. And I recall conversations in 2015 with the venture capital community about why high volumes of these smaller investors would be meaningful. So I've seen that shift in perspective there as well too. And again, thank you so much for joining here today. There's been so many, very valuable insights. If someone wants to continue the conversation with you, what is the best way for them to get in contact?
Yeah, they can send me an email at Jeff, Jeff. Actually, the easiest one is JLAW at cox.net. Or you can give me a call at 949-887-8877. That's my direct mobile number. So
excellent. And highly encourage anyone with questions to do so.
All right. Thank you so much. And let's talk later.
Okay. Thanks, Jeff. Thanks, everyone. See you next time.